Hey traders, Raghee here, and in this recap video I'm going to walk you through a very important step that we want to take in the S&P, in the Dow, and in the NASDAQ right now. And this is, I want to mechanize things, right? I'm a discretionary trader with a lot of rules, right? And one of the rules is to be able to make every decision about how I want to trade, what strategy to use, how aggressive I want to be, as objective as possible. So it's repeatable, right? So the idea that in situations where, whether that be crude oil, gold, the S&P, the Dow, if there are markets that have suddenly accelerated, over-accelerated, gone parabolic, I mean, the descriptions are endless. What do we do? What's the tactic to use? And oftentimes the same tactic is going to be the same thing if we hit an all-time high and we're not in the market and we want to basically catch up with it. And that is typically to go to shorter term time frames that aren't the daily time frame in an effort to take advantage of the next stop and correction and discovery of support and then a resumption of the overall trend. So I'm going to walk you through that process right now. And I'm going to use the Dow. Now, the numbers are different, obviously, but the process is the same. The tools are the same. So the first thing is, how do you know if a market is over-accelerated? And the way that we do this is with the price movement ranges. So we use a tool daily in the chat room and in the premium videos called Auto Chartist and specifically the volatility analysis. And what I'm going to do is take a look at the daily price movement range for the Dow, the YM contract. And I'm going to use basically a range that will take me, and this is not specific to the point, but it's a range, right? So I can be anywhere from about 150 to call it about 185. So what I want to do is take the 150 to 185, and that's 300 points, right? 300 points on the lower end. And let's just use that for now. 300 points on the lower end. I want to then take the high of the current candle. Now, of course, the high can be a moving target, especially in markets making all-time highs. But I want to take the high of the current candle, which is 25,282, and subtract 300. That's two daily price movement ranges. Well, that particular level would land me at approximately 24,982. Now, what is the relevance of that number? This 24,982, which would be right about here. Just about there, okay? What's the relevance of this? Even if I were to sell off on the upper end of price movement times two daily price movement ranges, heck, if I were even to do the 185, which is 370, and that brings me down to 24,900, basically, 24,912, am I anywhere near the 34 EMA on the high? Now, you might say, well, Rob, that's kind of arbitrary. Most technical analysis actually is, all right? But what you want to do is inject a certain amount of respect for historical price movement range, which is what that volatility analysis does. And then I want to be able to have a consistent way to determine when a market has actually gone parabolic or over-accelerated. So because the 34 EMA is still way down below 24,912, I know I have now an over-accelerator parabolic kind of market. So that means we're not getting a lot of corrections, deeper corrections. So I want to start thinking about shorter term time frames. And usually I'll start with the 60 or the 120. Now the next step I take is going to be taking that very same price movement range. So on Monday, I'll take about 155 points, subtract that from whatever the high is, and I'll get what I have is called a projected daily price movement low. In other words, if we were to sell off by the upper end of the price movement range, what the market is capable of doing on a Monday, if we were to sell off by that much, where would that land us? And would that price still be above the 34 EMA on the low, which is the red moving average on every one of these intraday and even end of day time frames? If I can manage to absorb that kind of sell-off and price can remain above the 34-period exponential moving average on the low, the red moving average, that then would be a viable time frame to take advantage of an entry, to take advantage of a shallower correction in this market. And that's what I'll do every day once we have an over-accelerated market. You can throw GC into that conversation. I believe we could almost throw crude oil into that. We can throw crude oil into that conversation. We can throw the S&P into that conversation, NASDAQ. So every one of these is meeting this criteria, and that is the tactic that I will use. I'll see you in the next update.